Do you own an investment property or are considering purchasing one? This decision is big on its own, but there's a whole new range of tax knowledge that you need to have. Today's video is all about tax tips for rental properties and some of the key considerations that you need to understand before you go and invest in property. If you've already invested in property, well, there's no better time to start educating yourself than today. The first thing I want to talk about is depreciation reports. You've probably heard people say, get a depreciation report, it'll save you thousands of dollars. But what does this even mean? So if you own a property, you may be able to claim depreciation on it. And this happens in two areas, capital works and capital allowances. So to better explain these, we have Division 40, which is capital allowances. And think of these as furniture, equipment. These are shorter term over a number of years, depending on the lifetime value of the asset. You then depreciate these and claim this depreciation in each year's tax return. We then have Division 43, and this is capital works. So this is more like fixtures, windows, buildings. These are the longer term things, and they normally claimed at a fixed rate of normally 2.5% each year. So depreciation report involves someone coming out and looking at your property. Now there are particular companies that specialize this. So they go through, they value everything in the house, and then they determine how much of a capital allowance and capital works deductions you can claim each year. They give you a schedule over a number of years, and then you enter those amounts into your tax return. Now you have to be careful though, because there were some key rule changes just over 5 years ago. So the key changes meant that you can only claim deductions for second-hand or used depreciation assets in rental properties if you purchase the property or the assets prior to 9th of May 2017. So this has significantly limited the benefits of depreciation reports for existing properties. Now, for new properties, they still work incredibly well. For older properties, you need to speak to the depreciation companies to understand whether there's going to be enough of a capital works deduction that's still going to make it beneficial for you. Now be careful, because obviously they're going to push you to do it, but give them details about when you purchased it, how old the house is and what it's worth to get a bit of an idea of, is this actually going to be worth it for me? These reports can be a little bit pricey. I know the last one that I seen the client claimed was about $770. So do your research, find out how much different companies charge, and make the decision whether it's worth it for yourself. In general though, the newer the property, the newer the assets, the more claim is going to be. The older the property, the less claims that you're likely to have. And obviously, the higher value the property, the higher the claims are going to be. The lower value, the less the claims are going to be. Now, why do people get these done? Well, it's because they're claiming a deduction in their tax return at the time. So this is happening each year. And this deduction is going to be lowering either the profit on the rental or increasing the loss on the rental. Now, there is a catch to this, because these deductions that you're claimed are going to reduce your cost base from a capital gains point of view. But the reason why it's attractive is a lot of people hold property for over 12 months and therefore get a 50% discount on the capital gains. So in essence, by claiming these deductions ongoing, they're getting an extra 50% overall, and they're bringing the deduction forward. They're bringing it earlier, not having to wait until the sale of the property. Another area that you need to understand when it comes to rental properties is utilizing debt effectively. Now, this is a very much an area where you need to do your own research. You need to understand how this works and ask your own questions. What I'm telling you is going to be very general. But in general, we have good debt and bad debt when it comes to a tax return, because good debt is the debt that we can actually claim the interest on. So in a basic situation, you go out and buy an investment property, you take out a loan for that property, you're going to be able to claim the interest against that property because that was the intention of the loan. Where it can get messy is when people start paying extra off their loan, maybe via a redraw facility, and then they redraw the money. So now we have a mixed purpose loan. We have the initial loan that we drew down for the property, where all the intention was to buy that property. But now we've redrawn off that loan, and maybe we've spent that money personally, and all of a sudden we now have a personal portion to that loan, and now we're having to split the interest portion. So be really careful if you're doing anything with the property when it comes to adjusting the loans after purchase. Something people like to consider when it comes to investment property is maybe they look at an interest-only loan. And this might sound crazy because you're not reducing your principal at all, but therefore the interest portion is going to stay high because your loan isn't being adjusted, and maybe they're directing their funds to pay down personal debt, such as maybe their main residence that's not claimable. So a lot of people try and maximize their funds they're paying down on non-deductible debt while keeping deductible debt higher. Now, this is a very overview approach. You need to look at things like interest rates, whether you've actually got the excess funds, and all of those other considerations that apply to your personal circumstances to work out how you can use debt effectively. This can be an area where it is worth getting that advice to make sure you're doing things the right way. Now, while I'm talking about advice, I drop a lot of free advice on this YouTube channel, and I do have the goal of hitting 10,000 subscribers this year. The subscriber growth has been growing crazy over the month of July, so I'd love for you to hit that subscribe button and help me get towards that goal of 10,000. Let's get back into the video. We really need to have a thorough understanding of capital gains if we're going to purchase property. And this is because at some stage with your investment property, you will encounter a capital gains event. And this occurs when you sell the property. Now, a key consideration is it's going to go on contract date, but what we need to work out is what is our sale price of the property less what our cost base of the property is. So the cost base will be made up of the initial purchase, plus maybe any costs that you had, such as stamp duty at the time, and then potentially we could have assets that we've purchased along the way that we haven't fully depreciated. We could have those other negative adjustments, such as when we've been claiming maybe a capital works deduction along the way. But we need to work out what the cost base of our property is. We're then going to need to work out what the sale price is. Now, this is normally easier to work out because it's normally fresh in your head. You can get the settlement statement. We can look at what we sold it for, less maybe the commissions and any fees we paid, to work out what our sale price is. Once we've got sale price, we've got our cost base, we can then work out what our capital gain or capital loss is. If we've held for over 12 months, we're going to get a 50% discount on that gain. And then we do need to make sure we split this gain depending on the ownership of the property. So if the property is owned 50-50, then this gain will be split 50-50, and then the discounts are applied at an individual level. Now that leads really well into my next topic, is ownership. We need to understand who actually owns the property, and is that the optimal ownership for the property? And this is a consideration you need to make before you purchase the property. So you need to understand, well, how do I want this structured? Am I buying this in an individual name? Is it going in joint names? Am I buying this through some type of entity such as a trust or a company? How would the property be owned? Now, for instance, if you're buying in joint names, is the property owned 50-50? Is it a 70-30 split? I've even seen people have a split of 99% and 1%. You need to make these decisions prior to making the investment because these are going to have massive tax implications. So from a pure tax point of view, we need to consider two different things when it comes to ownership. We're going to have the ongoing property income or loss. So this is what we declare each year based on our rental income less our rental expenses. Is the property going to be positively geared or negatively geared? A positively geared property, you're going to likely want from a tax point of view to be in the lower income earner. This is because they're going to be paying a lower tax rate. A negatively geared property, people will typically want in the higher income earner because they're going to be on more income, paying higher tax rates, and therefore the loss is going to have a greater tax benefit to them. Now, again, you can see this is a complex topic because, well, is your property going to be positive or negatively geared? How do you know that prior to purchasing it? This could also change along the way, and it's why you really need to seek that advice prior to purchasing the property. We then have potentially the opposite issue of when we sell the property. Maybe we've made a capital gain on the property, but we had it negatively geared and we had it in the higher income earner, and now we've got this large gain that's going to the higher income earner at the higher tax rate. Or maybe we've ended up with a capital loss, but we've got it in the name of someone who has no other capital assets and no ability to utilize that capital loss. It's why you really need to do this research prior to purchasing your property. I know I've mentioned about 3 times in a minute here, but it's so important to get your ownership right before you purchase your property. Now, your rental property will make up just one part of your tax return, and there's a whole range of other things that could go into your tax return, and that is why I've put together this upcoming playlist that is all about tax tips for individuals and helping you explain all different topics that could apply to your situation. I'd love for you to go and check that one out.